Welcome into Phil's Tax Hacks and Other Retirement Facts with CPA and personal financial specialist, Phil Putney. Now let's get rolling with today's show. Hey everybody, welcome into Phil's Tax Hacks and Other Retirement Facts. Phil and I back again to talk about retirement savings basics. A little, 101, Phil, on some accounts, kinds of accounts, what they do, pros and cons a little bit. Have you break these down for us as a CPA and a personal financial specialist. Who better to ask, some of the fundamentals of this stuff. So how are you, my friend? You doing good?
Doing good. Nearing the end of tax season. So it's all good.
Yeah, you're smiley. So it's like,
that's right.
Almost done.
I can see the end of the tunnel. So
there you go. Well, it seems like a good time to talk about some of these things. Not all accounts are the same. Not all accounts are taxed.
Absolutely.
Not all accounts function the same. So again, let's do some pros and cons on some of these, and then we'll finish off with just kind of some roundabout questions about them. But let's jump right in. So let's start with the first of the alphabet soups. We'll go with the 401k, the 403b, 457, TSP. I think that's it. They're all about the same.
Basically the retirement plans, company retirement plans. That's going to be the main characteristic of all of those is it's a company sponsored retirement plan.
So give us some pros and cons and best practices, I suppose, and advantages and disadvantages.
Yeah. So, first of all, you can't even get access to one of these unless you work for a company that has one, or you have a company that you've set one up, right? Because it has to be sponsored by a company for you to participate. In pros and cons, the biggest pro is company match. There's free money potentially involved.
That's always good.
Free money is better than no money for sure. So get your free money first.
I think free money is better than free lunch.
That's right. You can buy a lot of free lunch with free money. So
that's right.
But make sure you're getting the match, right? And that's going to be your biggest advantage in the 401ks is, or 403bs, 457s, kind of interchangeable. The difference is going to be basically the entity that sets them up. So 403b, 457, those are nonprofit type entities. 401k is going to be your for-profit company at a high level, kind of generally. So
let's think about some advantages, disadvantages for the individual. So obviously we've got the free money, which we covered, but so you've got limited smorgasbord of financial products, right? So it's going to be limited to whatever the company's doing, which is standard. We all know what the 401ks are, right? So they're going to have whatever the company is kind of going through. So you don't have as many.
So it's going to be one of the cons is it's going to be a very limited pool of options. You're not going to have the wide open options that you would have like in an IRA or self-directed brokerage account or something of that nature. Very limited options, which some people might think is better because now I don't have to look through all these different options. Here it is.
True.
Personally, it's going to be limiting, right? You don't get as many options. Advantages too.
I was going to say high income limits, which is great.
Right. So you can contribute a pretty significant amount. So this year, 22.5 for those under age 50. Or if you're over age 50, you can do another 7,500.
Yeah, 30 grand.
So you can put up to 30 grand a year in these. So you can put away a lot of money. Yeah, potentially can put it towards the Roth or the traditional side, right? So again, depending on your company plan.
Yeah, let's jump into that real fast because we're going to do the IRAs and the Roths in a second. But more and more companies now have a 401k Roth.
Correct.
And I misspoke a second ago. I meant to say that you could put a lot of money in when I said the income limits. There's no income limits when you have like a 401, correct?
Correct. Yeah. So there's no income limits. The goofy thing with 401k company plans in general is there's the IRS rules and then there's the plan rules.
Right.
And at the end of the day, the plan rules are what govern. And so 401k Roth is a great segue into that because the IRS allows it.
Yeah.
But not every 401k, 403b has it in their plan, right? And they
more
don't
and more
have to.
Are coming all the time, though.
Absolutely. But it's been out there for 10, 15 years now. The company plans can do it.
Yeah.
It's been a long time.
Yeah, it's a great hybrid of the first two things we're going to break down. So if it is an option, many advisors I talk to say absolutely you should take a look and see if it's something you could do within your company sponsored plan.
Right. So that's one advantage too, is that now you don't have the traditional Roth limits that you would have as an IRA in a 401k. It's the higher limits, that 22.5 or 7. Plus the other 75 or 30. So if you're trying to put a lot of money away towards a Roth, if the company plan is there, that's a great option to use.
And if you're a high income earner, then not having the limits makes it an option.
No limits, and yep.
Right. Which is a good
Yeah.
segue into our next bit of savings basics here. Let's talk about IRAs, whether it's Roth or traditional.
Right.
So one of the things right there, obviously, is going to be some of the limitations. So let's
Right.
start with the limitations, and then we'll talk about some of the pros of these.
Yeah. So the biggest limitation is just the dollar amount you can contribute, right? So it's going to be a much lower amount. For 2023, it's 6,500,
Right.
75 if you're over 50, so an extra 1,000. And that limit applies if you don't participate or are qualified to participate in a company plan.
Right.
So if you have no company plan options, then it doesn't matter what your income limit is. You can contribute to traditional IRAs.
Okay.
If you do have a company plan, then there's income limits that start to come into play, where you're going to be limited then potentially on how much, if any, you can put into an IRA yourself.
Yeah. Okay.
But I mean, if your income's low enough, I mean, there could be a point where you could max out the company plan. You could do an IRA. So
Right.
Again, it's just understand where you fit, what the options are.
You're getting into strategy. We want to stay with basics. We'll talk strategy in a minute. Right?
How much you want to put away. I mean, there's all sorts of topics to get into when you get it, looking at the plans. How do you blend them together, bring them all together? So,
and that'll be the kind of the point as we start to wrap it up. So
Yeah.
for the basics, so some of the cons, or it's limiting as far as the
so you
funds
can only,
and how much you can put in, but the pros, obviously, with both of them, IRA or a Roth, you have the smorgasbord.
It's wide open.
Available. Yeah.
Right. Yep. So you can invest in, I don't want to say anything. I mean, there are some limits from the IRS standpoint. You can't invest in collectibles. Let's put it that way. Is kind of one of the main limitations.
Care Bears are not on there.
No, Care Bears are not on there. Sorry, you can't do that. Anything that's a collectible, it's got to be held at a custodian. So I mean, there's definitely some limitations. It's not quite as wide open as you might want, but
Right.
And in Roth, you do have income limits.
Right.
The Roth IRA, versus like the 401k, you don't.
Right.
So, yeah, and with all of them, it comes down to what do you want to put away?
Yeah,
To start to look at options.
the tax-free side, obviously an advantage. Disadvantage is with
Right.
the IRA, you're deferring as
Correct.
usual.
Yep.
Same thing as the 401k, and then a Roth, you're paying the taxes now,
Right.
and then of course you reap in hopefully that tax-free benefit later on, right?
Yeah, and that gets into strategies of when do you want to pay the tax? Pay me now or pay me later is what it comes down to.
Yeah.
You're paying tax on the seed or the harvest is another way to kind of think of it. The seed, you're paying it on the Roth, paid after tax money goes in.
Yep.
Then all the growth becomes tax free.
Okay.
So great advantages there. Traditional, just the
Sure.
opposite. You got to look at where you're at currently in a tax bracket. Where might you be in the future? Yeah, there's a lot of strategy that comes into that. So
Okay, so that's
Yep.
some of the basics there, some pros and cons on those, the ones that we know pretty well.
Mhm.
Let's go to a simple IRA or a SEP. What are those pros and cons?
So Simple IRA or SEP are going to be, again, company plans. Typically, these are going to be for smaller companies.
Right.
So Simple IRA, I guess let's start there. It's basically, think about like an IRA that's bigger, right? It's your own account. First of all, it is a simple IRA, but it's yours. It's not in the company plan, but a company has to sponsor it. So your employer has to sponsor it.
Mm-hmm.
Income limits are higher, contribution limits are higher, I should say, net income limits. So 15.5 versus the IRA at 65. And then if you're over 50, it's another 35, so up to 19. So a lot of smaller companies will opt for the simple IRA because it's simple, right? There's no additional administrative cost from a company standpoint. Having a 401k, there's cost.
Yeah, I was going to say, how often do we see these? Because I know I've talked to some advisors. They're like, I hardly ever see simples.
It depends on your mix of clients. I mean, as a CPA back in the day when I was, did primarily the CPA work, we saw a lot of them because for smaller companies, it's
Sure.
very easy. It allows you to offer a benefit to your employees. Very streamlined, pretty simple. It's a lower limit threshold than the 401k, so they can't put away as much.
Right.
You as the employer are required to put in money, versus like a 401k, you don't have to. I mean, a lot of them have matches, but it's there's no cost to establish them. That's the biggest factor.
Gotcha. Yeah.
Versus from a company standpoint,
it's helpful
401ks, there's the administration and other costs associated.
So these
with
are
it.
helpful for the small business owner.
Absolutely.
Yeah.
And that's
same
where
thing with a SEP, right?
a SEP, yeah. So a SEP is basically, again, it's an IRA at the core, but it's a significantly higher threshold. SEPs are a little different in that it's not a dollar amount, it's a percentage.
Okay.
So it's 25% of wages or 25% or 20%, I'm sorry, of your net self-employment tax if you're self-employed. So a lot of times a SEP is something that an individual running as a sole proprietor would look at.
Okay. They might use something like that. Okay.
Right, because it allows you to put in a higher dollar amount than an IRA, depending on your income. But that's going to be the disadvantage is that it's income based. So if you had a small business, you made 20,000 in profit, as you're starting to look at these options, well, if it's a SEP, I can only put in 4.
Gotcha. 25% of the gross.
Yeah. If it's an IRA, I can put in 65 or 75 if I'm over 55 or 50, I mean. Or if I go to a simple, because it's single employer plan, I can do that as a simple, just as my own company.
Right.
Now I get that 13.5 or 15.5, or 19. So it really comes down to what type of entity you have, and then what's the goal from a contribution.
Okay. All right. So definitely some pros and cons in those as well. Yep. So let's go to HSAs and FSAs. Now we did a whole podcast on HSAs, so go definitely for a more in-depth dive. Definitely go back and check that one out, folks. A lot of good details in there. But for this, let's kind of go basics of what they are, pros and cons.
Yeah. So all the other accounts we've talked about so far are retirement accounts. HSAs, FSAs are primarily going to be health related. So HSAs for sure. So health savings account is a type of an account that you're allowed to contribute to and your employer, provided you have a high deductible plan.
That's probably a con. It's a high deductible.
Right. So that's the catch, right? You have to have a high deductible health insurance plan to get that. And there's pros and cons when you're looking at that. That's a whole nother discussion, because it really comes down to personal medical need, right? If you have medical needs and you use insurance on a regular basis, having a high deductible plan with an HSA might not make sense.
Yeah.
But if you are relatively healthy and you're not using it that often, it may make sense to go to the high deductible plan and start putting money into an HSA, because now the HSA, the advantage there is it's your money. So you don't have to spend it. I think of it like a retirement savings account for healthcare.
Yep.
And a lot of advantages, tax deduction when the money goes in, growth is tax-free.
Triple tax.
And ultimately tax-free when it comes out if it's used on healthcare.
Yeah. So big pros there for sure.
A lot of pros. And like you said, we did a whole podcast on using an HSA, pros and cons. Definitely look at that. Flexible spending account, on the other hand, is, again, a company plan that has to be established. So only available through your employer. HSA doesn't even have to be through your employer. The trigger there is having a high deductible plan. Now, a lot of employers will help set them up.
Sure.
But it doesn't have to be through your employer, because it's your own account. Versus the flexible spending is through the employer. Typically, it's going to be for childcare or for medical, or kind of the two different designations of where the money can go.
Okay.
Disadvantage with them is use it or lose it, right? And a lot of you probably heard of this many times, but you put the money in. If you haven't used it at the end of the year, it's gone. The employer keeps it, which you might think, well, that's kind of unfair. Well, the reason that happens is an advantage you have. Let's say you go into a company, elect to have a flexible spending healthcare account, and tell them, I want to put in $3,000 this year.
Right.
And this is January. So your first paycheck comes along and you put in, whatever, $150, whatever it is for that paycheck. Well, because you elected $3,000, if you had a $3,000 medical expense in January, you can present it to the company and they have to pay you $3,000 because that's what you elected. And now if you leave in February, they can't come after you for it.
Gotcha.
So that's just how they work, and why it's a use it or lose it.
Yeah,
right. They're taking the risk up front. So
and then you're taking
the risk on the end. Yeah. The bottom line with them, make sure you plan for how much you're going to need. And don't underestimate too much, because you can't, once you elected it, you're done, but don't leave money in there. This is why, you probably see at the eye doctors towards the end of the year, everyone's buying sunglasses. Well, there you go. They got money left in the flexible spending account and I got to use it somewhere. So I'm going to go get some more sunglasses.
Get some high quality sunglasses. Yeah. Okay. That's funny.
So, I mean, it helps give you the deduction, reduce your taxes, but it has to be used for one of those two items, use it or lose it. You can't have both. That's the other hinge is flexible spending for medical. You can't have that and an HSA. It's one or the other.
Okay, good. That's a good tip as well. All right. And then finally, some products like annuities or CDs, dividend stocks. So I would say one pro for some of these right now, Phil, is interest rates being up, right? So for annuities and CDs, that's making some of these things even more appealing. And like any product, there's the liquidity factors of things, right? So this is where the three worlds of money are going to come into play, where you're talking about safety, growth, and liquidity. So give us some pros and cons on these.
Yeah. So the first thing to remember when you're looking at them is, number one, all the different quote unquote types of accounts we talked about before are, think about like tax qualifications, right? Tax designations of an account.
Okay.
This last one, annuities, CDs, those kind of things, that's an investment.
Right.
And people often get confused of, especially annuities. You talk about an annuity. Well, an annuity that's not a retirement annuity is taxed differently than an annuity inside an IRA. An annuity in an IRA loses its characteristic of an annuity. In fact, any investment inside an IRA loses whatever characteristic it has because the tax characteristic rules. So, I mean, that's the first key to understand is
that's a great point.
When you're talking about annuities, CDs, dividend stock, whatever it is, those are investments. You can hold those inside of any of the accounts we talked about. From an investment standpoint, it really comes down to what are you trying to do? Annuities, a lot of reason to hold them. Primarily, it's safety, right? It guarantee a principal, or you're looking for guaranteed lifetime income. Yeah. CDs kind of similar to the point, you talked about those three different aspects of any kind of investment you can have: liquidity, safety, growth.
Yep.
So annuities, CDs, you're going to get liquidity potentially. CDs have some limitation, annuities have some limitations.
Mm-hmm.
CDs similar, they have some limitations too, but you have safety of principal.
Mm-hmm.
No interest rate typically, or annuities, you could have some upside depending on the type.
Typically, you're locking your money away for a period with both of them.
So, but it's more about safety. Dividend paying stocks. Now you're getting into it's kind of a hybrid. You have a little bit of safety in that. Typically, dividend paying stocks aren't going to be as volatile as growth stocks, for instance.
Okay. All right.
Just because of the nature of the companies that pay dividends. Usually they're larger companies, more established, Fortune 500. Been around a lot longer. Yeah, it's a stock. At the end of the day, that's the thing to remember. This is still a stock.
Right.
And it's going to go up and down with the market, typically not as much. The other thing is dividends. Yeah, you can count on it as income. And there's a lot of strategies around it. The warning I always have with that strategy is understand those dividends are not guaranteed.
Right. They're reported as income, right? So
and they're reported as income. But again, that kind of gets back to the nature. If it's in an IRA, it doesn't matter. I mean, if it's in just a non-qualified account, a taxable investment, we call it. Yeah, dividends, if you have it reinvested back in, you're not taking it, they just reinvest it back in. Well, you still get the privilege of paying taxes on that each year. Even if you didn't take the money. So pros and cons from a tax aspect, you got to understand, first of all, from a tax aspect, what are you trying to invest in to know then what might be the right vehicle for that type of an account. So,
Okay. So then the final rounding out questions, Phil, is how do we choose the right one, right? Many people wind up saying, okay, which one should I be in and will I be there forever? And the question really is no, right? I mean, it's like, choose the right one based on a strategy that you're trying to put together. For many of us, the first option of the 401 is where we're at because we've had a job someplace, right?
Right. I was going to say, usually the first thing comes down to what's available to you, right?
Yeah.
I mean, to your point, if you're still working, you've got some limitations on IRAs and or Roth. You can't have a simple yourself or a SEP.
Right.
So if you're working for a company, it really falls back to what do they give you from a retirement type of an account.
Yeah.
Then beyond that, you can maybe look at IRAs or Roths on your own. And then you get into the taxable investments, that's a whole nother type of an account you could have. But it comes down to first, what's available.
Yeah.
So there's no right or wrong per se. you have to look at what's available first, and then the long-term goal,
Yeah. And are you stuck in it forever is a question. It's like, no.
Right.
Well, so many people, and again, this is where the strategy of working with a professional comes into play, Phil, because so let's say we talk about it a million times. Most people are going to probably have a 401k.
Yep.
And at some point, their advisor, if they're working with a qualified professional, is going to start talking about shifting that money out of there and going into other things, right? Like converting it to a Roth. So for the tax-free growth, that kind of thing. So you can have multiples too, right? So
so there's
tons of stuff.
You can be that financial collector that has a bunch of accounts everywhere. Not generally a good idea because it makes it hard to manage things wherever they're at.
Sure.
But so you're not locked into 401ks forever. But I mean, that is somewhat of a downside, especially if you're younger. So if you are working for a company, you've been putting money in the 401k, that money is not accessible to you until you reach 59 and a half, or you get terminated, either voluntarily or not.
Right.
Some plans might have a loan provision where you could borrow from it if you need to, which again isn't necessarily a bad thing. It's not bad to have some money walled off that you can't get to. It's for retirement anyway, so you shouldn't be touching
protect yourself. Yeah, right.
But that's from an investment standpoint, you're kind of locked into that now until one of those events happen, 59 and a half. You get terminated again voluntarily or not. So
yeah. And at some point, if you want to start converting over or changing over, you can. And again, that's been really a big topic of conversation the past couple of years because of the Tax Cuts and Jobs Act. With the tax rates is where we're at. People are saying, hey, I've got, and again, this is just easy numbers to use. I've got $1 million in a 401. I want to start converting some of that to a Roth so that I have less of a tax time bomb waiting on me.
Right. Yeah. So then it comes back to that scenario. What does the plan allow? Some plans have that Roth provision. That's step one. Step two is, do they allow what's called an in-plan conversion? So within the plan, I can take money from the traditional and move it to the Roth side.
Yeah.
So if you have money in a 401k and it doesn't have the Roth provision, or if it does and it doesn't allow the conversion, now the only way to make that happen is it's got to come out of the 401k into an IRA.
Into your own
then you
IRA,
can do
Roth
converts.
IRA.
Right. Conversions into the Roth.
Yeah.
But then we're back to, okay, now it's locked in a 401k. Do I have the option of getting it out? How can I do that?
Yeah.
And typically that's going to be that age 59 and a half, or you're terminated from the plan, or, I mean, it's a, former employer's 401k. So if you no longer work at a company, then it's wide open to be able to position and do what you want.
Phil, if you're, because that's interesting. So, and many people I think might miss this. So if you're 50 and you have a 401k and you want to convert, you want to pull money out and turn it into a Roth IRA,
right?
You cannot do that without paying. You're gonna if they do let you, they're going to have to pay the penalty and the tax, obviously.
Well, right. So there's a lot of kind of hurdles to work through. Number one is, can you, right? If you're currently working at the company, you can't. There's no way to get that money out.
And I think people kind of think, well, I'm over 50. I can go ahead and start moving things, and you can't. Right.
And the 50 age, it really comes down to 59 and a half is the trigger. So that's where the penalty comes in. If you're over 59 and a half, there's no penalty.
And I think that's where people get stuck. It's like, well, that's fine. I'll deal with the penalty, but I don't think that you even can anyway, unless you
really can't. And there's no penalty on a conversion. So money being converted, it's not penalized, it's taxed.
Right.
Where people get caught in conversions and paying a penalty is if they're under 59 and a half and they're converting and paying the tax on the conversion from the account.
Yeah.
So if I'm converting 50,000 and there's 20% tax, so I tell the custodian, withhold $10,000 and send it to the IRS, and my 50 turns into 40 that goes into the Roth. Well, the 40 that went into the Roth is taxable. There's no penalty on that. The 10 that went to the IRS is taxable, and there's a penalty on it because it's effectively money you took, wrote a check to the IRS, and then sent it to them. So that becomes a taxable distribution that's subject to a penalty if you're under 59 and a half.
There you go.
So it comes down to strategy, right? What are we trying to do? Make sure you're working with somebody that knows how this works, because you don't want to get into a scenario of doing this conversion and then see your tax person around this time of the year and they're like, oh, by the way, you owe the IRS another $1,000 on that $10,000 tax you paid them.
Either they're going, you did what? Or you're looking at the bill you got to write, the check you got to write, going, I did what?
How did this happen? Yeah.
One of the two. So again, retirement savings basics. We got a little in the weeds on some of it, but we wanted to kind of run through, some pros and cons of the different types of accounts. And ultimately, at the end of the day, it's really finding the right strategy for the time of life that you're in and what you need to get done. And again, many of us have, the traditional accounts already set up, a 401k. Most of us are in these kinds of things because of the job that we're working at. But if you have some questions, as always, need some help, don't forget to reach out to Phil, especially if you're at that point where you're starting to think about how to maybe move or change some things, or maybe yourself a small business owner or whatever the case might be, and you're curious about a SEP or a Simple, whatever it is. Reach out to a qualified professional like Phil. Don't forget to subscribe to the podcast on Apple, Google, Spotify. You can also subscribe on YouTube as well. So lots of different ways to catch new episodes, and you can find it all at philstaxhacks.com. That's philstaxhacks.com. Phil, thanks for hanging out, buddy. Always appreciate it.
Thanks. Have a great day.
We'll be back with more next week here on the podcast. Don't forget to subscribe, and we'll see you later on Phil's Tax Hacks and other retirement facts.
Investment advisory services offered through AFS Wealth Management. The content of this program is provided for informational purposes only and is not a solicitation or recommendation of any investment strategy. Investments and/or investment strategies involve risk, including the possible loss of principal. There is no assurance that any investment strategy will achieve its objectives.